Hello, Vetri.
Yeah, hi, is that Vishal?
Yes, sir, it's Vishal. Good
Okay,
afternoon.
hi.
How are you?
Very well, how are you?
All good.
I can't see myself, I don't know, is it?
Would you turn on the video?
I think video is join as panelist, right?
Yeah, I've promoted you to panelists.
Yeah, hi Vishal.
Hi, Vetri, sir. Good afternoon.
Good afternoon, yeah. Yeah, I mean, just tell Ajay also because you need to join as a panelist to get the video, otherwise as an attendee you can't.
Okay, so once Ajay is on board as an attendee and Mr. Praveen, I just need Mr. Ajay to be online.
Okay, okay, sure.
Your audio and video is clear. I can hear you loud and clear, so that's good.
Hey, Vetri.
Okay. Hey, hi, how are you? And
All
I hope
good,
the
man.
light is the light fine?
Yours is all right. I'm going to put on a lamp shortly.
Okay.
But I'm just the warm-up act, so it's okay.
Yeah.
How are you
So
doing?
gentlemen, we will have, sorry to interject, we will have clients who will be logging on, I guess, slightly earlier into the webinar. This is now a live session. So once Mr. Ajay is online, I will promote him to a panelist and he will have the same functionalities as the both of you.
Vishal, are we live right now?
This is a live webinar, but there are no attendees as per se.
Okay.
I've yet to generate the YouTube link for the global sales.
Okay, and you will be running the slides for Vetri and Ajay?
Yes, I will be running the slides throughout.
I will basically take about 2 minutes to talk about global themes, which is Vetri, I'm just going to say welcome to everyone and then talk about that the world is now looking at signs of economic recovery. That's the first theme. Second, the nervousness about China. And third, the inflation issues, including oil and gas and energy prices. That's it. And then I'm handing over to you for your bit on macro.
Sure, got it.
And so I'm not going to be using any slides. So I'm just going to speak extempo, and then Vishal will help us through the slides, help you through the slides.
Perfect. So you're back in office, Praveen?
Yeah, you know, my neighboring flat is undergoing renovation, so it's really noisy.
Okay. No, but in the sense that offices are allowed to function in some form or fashion.
Skeletal. So only Manish and me.
Oh.
So we have pulled rank on everyone and said only we'll come to office. Everybody stays home.
So we've now got about little more than half the team every day. Just beginning October 1, we rolled it out. So it's between 50 and 60%.
Singapore was doing all right, but we've kind of gone into reverse gear as of 2 weeks ago. We literally clamped down again, and so it's crazy.
Well, let's see how it goes. They've opened up the schools, 8th standard and above. And yeah, they've opened up a hell of a lot of things, the cinema and so on and so forth.
I hope you're going to say in your vaccination slide that India is vaccinating 2 Singapores every day or 2 Switzerlands every day. You know, it's quite relevant to put it in context.
How many people are there in Singapore?
5.5 million.
Oh yeah, so we are comfortably doing about, I mean, actually not comfortably, but yeah, we've been averaging pretty close to 10 million a day for a while now. Hello.
Hello.
Hey, hi Vishal. Yeah, I think Praveen dropped off.
Yep. Ajay is online.
I got thrown out.
Oh, apologies. There we go.
Hey, Ajay.
Hi, Praveen.
Ajay, you want to test your camera?
I was just putting on my tie. That's why I was.
Oh, okay.
I thought you'd been your banyan or something.
Yeah, not in office. If I was taking it from home, possibly yes.
All right.
You got one of those.
Yep. Sorry to interject, guys. We have our key partners and stakeholders, some of our clients who have started to stream into the list, and the attendee list is growing, but I'm glad to have all four of you fully connected online, visible, loud and clear. And I'm happy to help in terms of any logistics you may need.
Sure, thanks, Vishal.
Thank you, sirs.
So maybe I'll just keep it on mute and put the camera off. We have another 5-6 minutes to go, right?
Yes.
So I'll kick off, Vishal, around 4:31, 4:32.
Yeah, maybe can probably give it about 4:32 and a half, just to let people who are in the other regions, internet connectivity, some bandwidth to come in.
Okay. What I'll do is I'll put my headset on, Praveen, because there could be some background noise around my desk.
Okay.
Sure. I'll also keep my camera off and then not log in, but maybe switch it on at sharp 2 o'clock India time.
Ajay, I'll introduce Vetri first, and then Vetri will introduce you. So, and I'm going to be speaking for about 2-3 minutes. So I'll keep my video on when I'm speaking, and then Vetri will keep his video on when he's speaking, so on and so forth.
Sure. I guess during Q&A, we can all keep it on.
Yes.
And Vishal, this one is for you. Basically, Vetri has replied back to your mail.
Yes.
And has also suggested which one of us would be taking those questions.
I have it right in front of me.
There is this last question, which I think is on markets have gone up sharply year to date. I think we can just skip that because in any case, we are covering this in the previous questions.
Understood. I will do that. Yep.
Okay.
Thank you.
Thank you.
Well, good morning and good afternoon, everyone. We're going to just give it a couple of more minutes. I can see a lot of people joining, this streaming in. So give it a minute and then we'll commence. Thank you for your patience. Well, good morning again and good afternoon. Welcome to the quarterly equity call of UTI. My name is Praveen Jagvani, and I'm responsible for the international business of UTI. On behalf of all my colleagues, thank you very much for joining us today. We have over 180 people who registered for this call from across 21 countries, from Asia, Middle East, and Europe. I know that some of you have sent across questions you wish answered by our expert speakers, Vetri and Ajay. We will have the Q&A session after the formal presentations, so there is still time to pose your questions on this facility in the messaging box, where some of you have kindly sent welcome messages. Our last call was in June, when there was still a great deal of uncertainty around COVID. But with the rapid pace of vaccinations around the world, as well as in India, the attention has once again returned to the nuts and bolts of the economy. In the past few months, there have been three main themes that have driven investor behavior. First, of course, is the post-pandemic economic recovery. And positive signs of this recovery are nearly everywhere around the globe. Second, is the increasing disruption brought about by China in its markets and its businesses. It started with the tech sector initially, then the education sector, and now the real estate is struggling with excessive debt. The world is keenly watching how China manages the end game on its internal issues. But in the interim, the world is nervous about China, and equity allocations are moving fairly rapidly. The world is nervous and trigger happy. The third theme is the rising specter of inflation. Once again, both globally as well as in India, and how this influences the Fed tapering, the glide path of interest rates, as well as the role played by oil and gas in the whole energy crisis we are witnessing right now, how it will stimulate inflation, whether it'll be short-term or whether it'll be sustained. All of these things will determine what the next couple of quarters look like. So we think these three themes are relevant in setting the context for understanding the outlook of India, economic recovery globally, the nervousness around China, and the rising inflation and energy crisis. Within India, the business community is exhibiting considerable optimism, and the markets have responded to both the positive data and the positive sentiment. As a consequence, India has become the best performing equity market this year by a mile. And to shed more light on the macro outlook, I'd like to invite my good friend, Vetri Subramaniam. Vetri is the CIO for UTI Asset Management Company and an industry veteran of nearly 3 decades. Vetri, over to you.
Thank you. Thank you so much, Praveen. It's good to be able to connect again. More than 3 months since the last call. And of course, when that previous call happened, it was happening in the backdrop of a fairly severe second wave of COVID in the country. But thankfully, we are in a far better situation today, and I'll be talking about that, as well as alluding to some of the other points that Praveen made in terms of what's currently happening in the economy and where we stand in the context of the valuation cycle, which is even more pertinent perhaps at this point of time, because not only is the market at a lifetime high, which is sort of understandable, but more importantly, it is at a significant valuation premium to its long-term averages, but we'll talk about that later. So diving straight in, Vishal, if you could just move to the first slide. Right. So the first slide is really about the current trend in COVID cases on a daily basis, which you see on the left-hand side. And as you can see over there, the 7-day moving average of new cases, which is the red line, is in fact running below 30,000 cases a day. If you go back to the month of May, the daily case rate was running at over 400,000 cases on a daily basis. So, there's been a drop of almost 90% from the peak daily caseload, which happened during the second wave, to the point where we are today. Multiple reasons, certainly one of them for these better outcomes in terms of daily cases has been India's success on the vaccination front. There were some, sort of hiccups early on in January, February, when perhaps the government was a bit slow to get its vaccine supplies in place. Thankfully, India has been blessed with the fact that we have two entirely indigenous sources of manufacturing and 2 vaccines which are currently approved and being widely administered. But there are 1 or 2 other vaccines which are already being approved or in the stages of receiving final approvals. So I think during this quarter, it's very likely you'll see 4 vaccines being widely used in India. The run rate of vaccinations is running at actually closer to almost 10 million a day. And just before we got this call started, I was talking to Praveen, which means that in a single day, we could inoculate the population of Singapore 2 times over, or the entire population of Canada could get its first shot in 4 straight days, because that's the run rate that we seem to have managed to get to, which is almost, as I said, 10 million a day. So that's sort of helping significantly in terms of preventing significant caseloads and certainly preventing the loss of life, which is really the end objective that all of us have, which is to reduce the loss of life. And that's what really seems to be making a difference. Moving on very quickly. What's been happening in terms of the pace of vaccination. You can see that on the left-hand side. As I mentioned, the pace of vaccination actually is now comfortably above 7 million vaccines a day. It's closer to 10 million vaccines a day, which means that by the time we get to December 21, it's very likely that over 60% of the population would be, vaccinated. So I think, given the slow start we had at the beginning of the year, that's a fairly good outcome. And it's good to see the entire government machinery, as well as the private healthcare sector, get behind this vaccination program. The vaccination program is also giving people to start stepping back out of their houses, back into offices, back into restaurants, bars, aeroplanes. And the first signs of that are on the right-hand side, where if you look at the black line, which is the PMI for services, For the first time this year, it's actually rising sharply and has actually crossed the trend that we are seeing for PMI manufacturing. And we know that for a fact. Our offices in Mumbai, now we are operating at a daily turnout of close to 50 to 60%. And if you were to step out, the roads, the trains, the buses, the bustle is back. The restaurants are open, the cinemas are open, and even the airports are certainly coming back to life again. So this is certainly helping the overall services recovery in the country. Moving on, Vishal, to the next slide. When we think about it from a larger context in terms of the different constituents of GDP, we talked about this last time as well. But the biggest, contributor to the recovery in the economy, if you go back to March of 20, pre-pandemic, has actually been exports. Exports in the first half of the year from India, this is just the exports of goods, are close to $200 billion, which means on an annualized run rate, it should be about $400 billion. This is very welcome news, not only because it's strongly in positive territory. On a 2-year basis, in 2020, exports were only about 312 billion. So we're up more than 25% on a 2-year basis. Equally importantly, exports from India of goods have been stuck at about the 300 to 330 billion mark for almost a decade now. So this is really the first time we've punched out of that range and heading closer towards 400 billion. As you can see over there, most of the other elements still running below the COVID trend. Government has been pressing the pedal as best as they can, but not much of a difference between private consumption, government, or fixed investments. It's really exports which have made the big difference. If we just move to the next slide, Vishal. I think one of the good things is that not only do we have a strong export sector at the current point of time, but equally it's positioning India fairly well relative to the concerns. And to all of us who remember 2013 and the summer of 2013, the taper tantrum, and the Indian currency at that point of time was really badly hit. It was considered one of the fragile 5. It fell by almost about 20% plus. And just look at where we were in 2013, the blue line, we were actually trending at a current account deficit of close to about 5 to 7% pre-taper tantrum. Today, the current account deficit is actually very comfortably placed in a positive territory. So we actually have a current account surplus. So this is one of the things which gives us some comfort that relative to concerns about a taper tantrum, India's economic data is very different compared to where we were in 2013 summer. The capital account continues to be in a healthy state of a surplus. Of course, that has always been the case in India, except for, again, that awful quarter of the taper tantrum in 2013 when it went negative. So that remains in healthy position, and the trade surplus, or rather the current account surplus, coming into positive territory only gives a little bit more confidence that we're well placed relative to any concerns about market volatility and a taper tantrum. Moving on to the next slide. I think this is one of the data points which suggests very clearly that the animal spirits are not really back at this point of time. If you look at overall credit growth in the economy, it's muted, running at about 6.5% year on year. But interestingly, despite many of the anecdotal as well as other data points which suggest that consumer confidence and perhaps retail confidence is down, retail credit growth has actually not done too badly. It's actually trending at closer to about 12% on an annualized basis. So overall credit growth at 6%, retail growing at closer to 12%. The reason for sluggishness is actually got to do with the profit boom that the corporate sector is enjoying. And when we look at the numbers of the Nifty 500 companies, we clearly see that their cash flows have been so strong through the last year, they've actually deleveraged, and that's reflected in the leverage data for the corporate sector, as well as the anecdotal data that our analysts in capital intensive sectors are telling us. So yes, it is a little bit anemic relative to trend, but good news, positively supported by retail. Corporate weak, but for a good reason. They're making so much money, and obviously they're not able to deploy that back into investments at the same pace. They've been able to deleverage. Moving on, Vishal, to the next slide. This is one of the other things. Not only has there been a profit boom in corporate India, but actually tax collections for the government are pretty much the best that I can recollect in literally a decade. The fiscal deficit for India, always a pain point. Our target for this year is about 6.8%. But if I look at the strength in the tax collection, and I adjust only for the strength in tax collection, the deficit could actually be 0.5% to 1% lower than target. Now, eventually it may or may not get there, because remember, there are some big disinvestment or privatization proceeds which are part of that budget estimate, and we'll need to see whether the government is able to get those privatizations done. But this is certainly great news. At this point of time of the year, normally India has already hit 57% of its full year fiscal deficit target. This is the first year where we are running at only 31% of the target, the lowest that we've seen, I think, in more than a decade. And you can see over there, across the board, income tax, corporate tax, customs, excise, all of them surging and doing very, very well. Moving on to the next slide. As I mentioned earlier, one of the concerns we have is that this is a little bit of an unequal recovery. You look at the listed companies' profitability on the left-hand side, and you can see that in FY21, there is actually a sharp improvement in profitability, so much so that it pulls it to the highest level that we've seen since 2015. So this is a pretty remarkable, surge in profitability that we've seen in the corporate sector. However, when you look outside of the listed sector, so not just corporate sector, but the listed corporate sector, the picture looks very different. The unlisted corporate sector wasn't doing too badly in terms of profitability, even in 2018, unlike the listed corporate sector. But over this 2-year period, if there's one part of the economy which has registered pain, it's essentially been the unlisted corporate sector, perhaps because a lot more smaller companies present there. And of course, I'm not even talking about the entirely unlisted, unincorporated private enterprises, the small businesses which don't get captured in this data, where anecdotally at least we still believe that this is the last segment possibly to emerge from the difficult period of the pandemic. So it's been a little bit of an unequal recovery. One of the things that we discuss in India constantly is that, is there likely to be a capital investment recovery? Because this has been missing in action for many, many years. And if you look at the left-hand side, you can see the capacity utilization trends. This is based on data published by the Reserve Bank of India. One of the challenging things when we look at this data point is that capacity utilization, even coming into August of this year, based on the RBI survey, seems to be below 70%. And what we've seen historically is that you require capacity utilization. This is across a host of industries to push above 80% to really drive the capital investment plans of entrepreneurs. So we aren't there as yet. But one of the initial indicators that we would look for is certainly in a very good position, which you see on the right-hand side, which is the debt equity ratio of the non-financial companies in the BSE 500. And you can see over there, this is pretty much the lowest leverage that we have seen going back all the way to 2003. And those of you who've been in the markets long enough tracking India would know that 2003 was really the last time we saw a large capital investment boom take place in India. So we've got 3 favorable factors for a potential pickup in capex: strong corporate profitability, a reduction in the debt on balance sheets, and also a very attractive interest rate and an attractive tax rate. What we don't have is the capacity utilization levels, which have typically driven entrepreneurs to make investment decisions. So moving on from that, valuations, where are we? This is the most challenging slide because, in a way, all the good things that I told you are arguably already captured in this slide, where you can see valuations going back 10 years. And as you can see, they've literally punched their way to, record valuations on a forward basis, and we're expecting almost 38-40% growth in the Nifty EPS, but that's already discounted with valuations now trading up to the highest that we've seen in a decade. And of course, even if we push the calendar back to about 20 years, this is a significant premium, to that average. So yes, valuations are punchy, and you do worry about the fact that these have actually pulled returns forward and could eat into, forward returns, so to speak. The next chart, again, the same metric and the same sort of valuation picture, but just showing you the price to book and the return on equity. Price to book again has, charged up to a new high. The good news, because of the profitability recovery, is that the ROE is starting to rebound quite significantly for the Indian corporate sector. But again, the message from valuations, markets are rich. So finally, just to conclude, on the next slide, this is pretty much the points that I've talked about. Economic activity rapidly normalizing post the second wave, visible across a host of high frequency indicators. Inflation quite sticky in India. That is a little bit of a cause for concern for all of us. And while policymakers in India are calling it transient, not very dissimilar to what policymakers in the US are calling it, we do worry that India's trends are slightly more tricky than perhaps what you're seeing in the US. Having said that, the Monetary Policy Committee is still very, very supportive of growth, looking to the fact that there is a positive output gap. Remember, we talked about capacity utilization and also weak credit. So, policymakers, the monetary policymakers, looking at these two indicators and saying we still need to be growth supportive. Tax collections, extremely robust. The union government has talked about increasing investment spending, but we haven't seen it as yet. It's also not so easy to convert revenue into investment spending, so that hopefully will happen with a lag, but we'll have to wait and watch. Outlook for exports, very, very bright. The trend is strong. And incrementally, I would add, even the outlook for services starting to look a lot better. The challenge is the elevated valuations relative to history. Potentially, these could be a drag on returns. So, that's sort of a quick summary on where we see the macro at this point of time. And as we've done in past calls, I'll maybe take a pause here and hand over to Ajay, who, as his style, is completely bottom up. So, a lot of what I said is just to paint the larger macroeconomic picture for you. But, Ajay's strategy is entirely bottom up, and, he'll talk to you about how he's positioning within the IDEF strategy. Over to you, Ajay.
Thanks, Vetri. Welcome, everyone. We'll quickly dive into the section on the fund. I have a few slides here, which will just try and capture whatever activity we have done in the last 12 months. And of course, we'll open up a questions post. Just to reiterate our investment philosophy. As mentioned on this slide, our starting point is always hunting for businesses that stand for quality. It is our firm belief that sustainable wealth creation can happen only if the business is generating intrinsic value, and not just at a particular point of time in the cycle, but basically through the cycle. And I think it is with this intent that our portfolio is always built around businesses that have the ability to generate return on capital higher than their cost of capital at all points of time in the cycle. And it was very reassuring for us to see 95% of our businesses in 2021, the year of the pandemic, by which I mean financial year 2021 or calendar year 2020, which was, I guess, once in a generation kind of a drawdown event. And yet, like I said, 95% of our businesses were able to generate return on capital higher than their cost of capital. I think that is sufficient proof of the fact that we really look at businesses with a very strong prism of quality. Only those businesses which are able to check the boxes on quality are the ones which get into our portfolio. But we don't stop there. After hunting for quality, the second most important thing for us is growth, because we do realize that while businesses ought to be creating value, but they ought to be growing that value year after year. And the more sustainable the growth rates are for businesses, again, the more sustainable becomes the compounding of this intrinsic value. So growth remains our focus. But I've always mentioned this, and let me reiterate, growth comes only after quality. We would never fall for a business which has the prospects of long-term growth, which falls into an industry which has very strong growth tailwinds, but lacks quality. We haven't touched infrastructure businesses in India, knowing fully well that infrastructure is that space where for decades altogether, there's going to be a huge amount of growth. But because they lack that quality, because these businesses have poor ROCs, patchy track record of cash generation, very high upfront capex, which just pushes down their profitability all the time, and therefore leads to huge amount of debt on the balance sheet. All of these reasons put together have always kept us away. So it has to be quality first, and then within this set of high quality companies chasing growth. Last but not the least, valuation. We are certainly not a growth at any price philosophy. Valuations are important for us, but where we differ from the market is trying to value every business purely on price earnings or price to book or even enterprise value to operating earnings. We like to look at the cash flow generation of a business, and we know that while price earnings businesses of certain businesses of certain companies can be very low, but that doesn't mean that they are undervalued. Equally, on a price earning metric or a price to book value metric, certain businesses can be very expensive optically, but that doesn't mean that they are overvalued. And therefore, we like to evaluate businesses again from a full cycle perspective, looking at their ability to generate cash flows and grow these cash flows over the long run. Next, please. This is a snapshot of our portfolio in terms of our sectoral exposures on 30th September 2021 compared to 30th September 2020. As you can see, hardly any change. And that's how we've always managed this portfolio. We at least take a 3 to 5 year view. We basically are bottom up. So while these sectoral exposures may appear to be constant to you, but that's not because we have a particular positive or negative view on the sectors. It is more on account of being positive on businesses, which ultimately add up to these exposures. And because our view on businesses is more from a 3 to 5 year perspective rather than just a few quarter perspective, we see our overall sectoral exposures also remain fairly unchanged from year to year. And that's the story in the past 12 months as well. We remain positive on India's financial services. That's the highest weightage in the portfolio. Within financial services, we are predominantly bullish on certain private sector lenders. The big four in our portfolio, which is Kotak Bank, Bajaj Finance, HDFC Bank, and HDFC Limited, form more than 20% of this 25% exposure that you can see. Consumer goods and services, again, something we've been bullish on. And this is a story which is absolutely congruous to India's improving and increasing per capita income. And therefore, consumers in general having a larger wallet share towards various product services at large. And as India's per capita income continues to grow, we would see the overall consumption sector in India continuing to do well for many decades. IT services, the third one, and I think this has helped us a lot in terms of our performance over the last 12 months. Of course, these are not technology companies like in the US. These are predominantly services companies which implement the technologies which are usually in vogue. So for instance, we talk about how businesses around the world are getting onto the cloud, are using various digital technologies as one of their core strategies, not only to cut costs, but also to acquire customers and keep those customers happy. It is these IT services companies like Infosys, TCS, L&T Infotech, Mindtree, which basically implement these technologies for the Fortune 500 or Fortune 1000 clients around the globe. And as we have seen a very sharp shift towards the digital technologies, towards cloud and so on, IT services companies have also been able to see very, very strong growth. Their order books, are increasing every other quarter, and that gives visibility for strong growth over the next few years. Pharmaceutical, auto, and healthcare services, the other three exposures here, are also quasi-consumption related themes. Of course, auto is a consumer discretionary sector. Pharmaceutical and healthcare services, if I put together, it's almost 15% exposure in our fund. And this too is linked to India's improving per capita income, and therefore the propensity of the consumer at large to spend towards their health and well-being. Next. This is a snapshot of the top 15 holdings in the portfolio. Here too, a very similar story as compared to the previous slide. Not much changes over the last 12 months. Our top 15 holdings are pretty much the same. Of course, due to mark-to-market movements, there would be some change in the exposures. But again, the same theme. We like owning businesses basis their outcomes over the next 3 to 5 years rather than how their stock prices will move from one quarter to the other. And if we really follow this strategy, it is only obvious that our churn ratio would be very low, and therefore our sectoral exposures and our top 10, top 15 holdings will also not change from year to year. Next. This is a slide on the new entrants in the portfolio over the last 12 months and what we have exited. I would say typically in every year, we would see in over any trailing 12 month period, you would see 3 to 4 new additions and 3 to 4 exits. Possibly in the last 12 months, we've seen slightly higher than average, although this hasn't moved our overall portfolio turnover ratio outside of our 10 to 15% kind of range. But yes, the last 12 months did open up a few opportunities. India's IPO market has been extremely active in the last, I would say, 18 months. And that has brought a lot of new exciting business models into the public markets. And I think it is a function of this that we have also participated in a few. I have said previously that even when we participate into IPOs, we never forget our quality check. We never forget the fact that we have to see strong execution by the management in the past. So therefore, we are not extremely participative in the IPO market. We are following the same rule book even now, but possibly if 10 new IPOs used to come, let's say 2, 3 or 4 years back, we're now seeing 30 to 40 new IPOs coming in. Perhaps that's the reason why, you would see every now and then, maybe in an odd year, you could see us participating in 1 or 2 or 3 IPOs. But we will still stay extremely vigilant about the IPOs, and only those businesses where we are sure about the execution track record, where we are sure about the management quality, would we participate. Next. 2 quick stock examples, just to give you a sense of how are we looking at opportunities in the Indian markets. L&T Infotech Services. This is one of our key holdings. It is, as the name suggests, an IT services company. Actually, India's 6th largest IT services company, specializing in the BFSI sector. And I think the success of this company is also on account of the fact that they saw the wave of digital technologies, especially companies moving things on the cloud very, very early. They created a separate division just for cloud. Not just that, within that division, they bifurcated the division into 3 different verticals. One which is specializing in the implementation of, let's say, of AWS, one which specializes in the cloud solutions brought in by Google, and so on. So I think they realized that cloud is going to be a huge area of interest for their clients. They also realized that some of them would prefer Amazon, the others may prefer the solution given in by Google, and so on, and maybe somebody would prefer Microsoft. So they created within this division 3 separate verticals, and I think that has actually helped them a lot in terms of their go-to-market strategy, convincing their clients that they have specialized teams trained for this implementation. And that has helped them a lot in terms of their growth over the last 4-5 years. They have been the fastest and the strongest growth company from India in the IT services domain. As you can see, approximately 18 to 20% CAGR growth over the last 10 years on revenues, operating profits, as well as net profits. Next, please, Michelle. So these bar charts basically show the highly consistent growth outcomes, both in terms of the revenues and profits on the top right-hand side. On the bottom left-hand side are, again, a very consistent set of outcomes on both operating cash flows as well as free cash flows. In fact, free cash flows and operating cash flows have grown at a rate significantly higher than the growth in revenues and profits, which again shows that while they've been winning this business, but they have not been winning this business by compromising on quality. They have been improving their ROCs all along. They've also been improving their working capital. Yeah, next please. The second one is from the consumption space, Jubilant Foodworks. This is India's largest food services company. This is India's largest QSR, which is quick service restaurant company. It is also India's largest in terms of the pizza segment. So this company basically has been the master franchisee for the Domino's brand of pizza over the last 25 years. Of course, it has been able to meet with strong success only in the last 10 years, because the prior 15 years were to set up the proof of concept, was to set up a test case for their customers, and they basically started only from a few cities initially. But over the next 10 years, after their inception, they were able to establish this entire thing in front of their customers through the length and breadth of the country. And in the last 10 years, they've grown, but profits have actually grown faster than their top line. But of course, the company hasn't stopped at this. They have been experimenting different formats based on their success in the pizza category. Within the overall quick service restaurant, I would say, arena, they have been trying to launch a few other cuisines, like the Chinese cuisine, and also a very famous Indian cuisine, which is called the biryani, which is nothing but a rice dish, but it can be made in different ways. So these are the attempts made by Jubilant to increase their addressable market. At the same time, within the Domino's pizza area, they have been expanding to other countries within the subcontinent. They also have the master franchisee agreement for adjoining countries like Bangladesh and Sri Lanka, which have very similar demographics compared to India, and therefore Domino's would want to replicate the success of their model here in India in these countries as well. It's already meeting the early success in Bangladesh. It has also taken the master franchisee for the Popeyes brand in India and is soon going to roll out stores. So it's a company which is basis its success and proof of concept delivered in the last 25 years in the pizza domain, trying to replicate that in other domains. It remains a debt-free company, generates huge cash flows, but is reinvesting these cash flows by entering into the few areas that I explained to you. Last slide on this topic is again the same thing: consistency in growth in this business, both in terms of sales and profits on the top right-hand side, as well as in terms of operating profits and cash flows at the bottom left-hand side. Please do register the fact that, of course, FY21 has been a washout year for most restaurants around the world, and also the fact that consumer sentiment over the prior 2-3 years hasn't been strong. Despite all of this, they have been able to churn out mid-teen numbers over the last 10 years. So I think I'll stop here. I guess, Vishal, we can now get into the Q&A.
Yes, indeed. Thank you very much, Praveen, Vetri, and Ajay, for running us through the introduction, the macro themes within the Indian domestic economy, and of course, with a very interesting walkthrough of the portfolio, the companies, and the growth model that's always been evident within our portfolio. Yes, indeed. We now come to our final segment of the event, and we do have prepared questions from our clients and partners that have been sent through prior to the start of the webinar. Now, first up, I'd like to direct the question to Ajay. Would you be able to comment on valuations? Are all corners of the portfolio and the market expensive, or are there still pockets of value to be extracted?
Sure. I think that's a great question in the context of where we are. Of course, Vetri did mention that we are expensive, and there is no doubt about it. But here's the beauty about our business. If you go back 20 years, you can pick any time frame that you want to pick. You can pick the most bullish phase in the last 20 years. You can pick a bearish phase. You can pick sideways market. The fact remains that in every time period, there are a few sectors that are always favored, and there are a few sectors that always fall out of favor. You can take the period of 2004 to 2008. Those were the go-go years in emerging markets, India included. There were a few sectors which barely participated in that rally. IT, consumer, pharma come to my mind. In the phase post the Lehman crisis, when emerging markets in particular went through a tear, for those 3 or 4 years, between 2000, let's say early 2009 to 2013, IT and pharma did extremely well. But then after that, post 2015, these sectors again fell out of favor. And post 2015, it was more about banking and the consumer sectors, and also the auto sector, which did very well for 3 or 4 years. So you see, every 2 or 3 years, like I said, you would always see sectors, regardless of the direction of the market, which would be out of favor, and some sectors which would be experiencing momentum. It is up to you as an investor whether you want to chase momentum or take a step back and see whether these out of favor sectors still hold the prospect of creating value and growing that value in the long run. We've always realized that whatever be the time in the market, there are always sectors, there are always businesses which have strong prospects, as strong as they ever displayed, and yet they are out of favor. In the present context, the entire auto pack, private sector banks, consumer goods, and pharmaceutical sector. These are the 4 sectors which have barely participated in the market. This market in the last 12 to 18 months has been driven by metals. It has been driven by real estate. It's been driven by PSUs in general. Within PSUs, PSU banks. It's been driven by infrastructure. We don't hold any of these names, not even a single share across. So yes, we are finding opportunities. We are not actually, looking at a situation where we may fall off the cliff. Many of our favorite sectors actually haven't participated in the last 12 to 18 months. Yeah.
Understood, Ajay. Thank you so much for the very insightful answer. Now, again, over to you. How are you playing the transition to the formal economy or new tech in the portfolio?
Sure. I think the formal economy is something we've been playing for a very, very long time now. I spoke to you about Jubilant Foodworks, India's largest food services company. It is essentially nothing but the unorganized to organized shift. The standalone restaurants, the roadside restaurants, all of these are losing market share towards the more organized players. The fact that we are bullish on certain retailers like Avenue Supermarts, which is one of the largest retailer in food and grocery, where again the theme is that the mom and pop stores are going to cede market share to the organized guys, just like Walmart, from the 1970s till date has been able to continuously increase its market share. So is going to be the experience here in India with a few retailers. It all boils down to how well can some of them execute. Jewelry retailing, Titan, we've been extremely bullish for the last decade. It's a similar theme. Standalone jewelers will cede a market share to organized jewelers like Titan. In fact, in healthcare services, diagnostic companies like Dr. Lal and Metropolis are again a theme about unorganized to organized. So I think that's the thing we've been playing very well over the last 10 years, and we will continue to have opportunities. It's the tech part which is something which is new. In some sense, InfoEdge has been a very successful tech company, has been in a portfolio for 10 years. Many of you have seen it. India Mart is something we picked up just before the pandemic. But of course, now we are seeing, like I mentioned, a lot of new age IPOs where a lot of these tech companies are coming in. Many of them our view here at UTI is that many of them would scale up to a level which is significantly higher than at what they are today, almost like what has happened in the West. And we would always keep our eyes and ears open for such kind of companies which have the ability to scale up, but more importantly, profitable scale up. So yes, we would continue to see, I would say, introduction of few of these names into our portfolios gradually over the years.
Thank you, Ajay, for the very valuable response. Now, Vetri, over to you. What the audience would like to know is that do you see any repercussions from the likely default of Evergrande to the Indian economy and the companies within the portfolio? And also the second part, do you see something similar like this happening within India in a highly leveraged market, company or sector?
Interesting question. Well, I would argue that actually India's Evergrande movement, so to speak, actually happened all the way back in 2018, where the ILFS, Infrastructure Leasing and Financial Services, which was actually in many quarters seen as being a government-owned company, though the reality is that it never was, sort of overnight collapsed. And I think between the debts that the company had directly as well as some of its infrastructure subsidiaries had, maybe there was close to about $20 billion of debt. So that was really the moment which set off panic in the Indian financial sector. And we did, of course, see quite a few non-bank financial services companies go through a period of stress all the way through 2018-19. And all this was sort of the knockdown effect of what happened in IL&FS. So I think in that sense, India's financial sector has already gone through a little bit of a shock. And in fact, going into the pandemic, because risk appetite was already vastly reduced due to what had happened over the previous 2 years, the financial sector hasn't done too badly. So no, I don't think Evergrande by itself has any direct impact on India. And I think the equivalent of the shock that Evergrande is perhaps sending through China actually happened in India in 2018. And there's nothing that I see right now as posing a similar risk. But again, you've always got to watch out for what you don't know. So we can never say never. But I think the system has been through the period of stress, and because of the pandemic, there hasn't really been a strong credit growth or recovery. And to my mind, typically these sort of credit issues arise after a period of sustained credit growth. That hasn't happened in the last 4 years in India. So I'd be skeptical about something like that happening at a systemic level.
Understood. Thank you so much, Vetri. I think it's very comfortable to know that the domestic economy has passed that stage and relatively the fundamentals are looking right to prevent a sort of a similar Evergrande situation in China happening in India. Thank you so much for that. Moving on to the next question. This is back to Ajay again. Do you have any concerns on the size of the fund?
Yeah, this is a question we are asked almost every time we have a conversation like this. You see, the answer is no. And I've always said that the reason for us being extremely comfortable about the growing size of a strategy is the way we run the strategy and the way our thought process around owning businesses for the long term is, rather than looking at stock prices and taking advantage of stock price, which inevitably would lead to higher churn. So the fact that we look ourselves as owners of businesses and the fact that we give ourselves at least a 5-year time frame when we want to own something, when we get excited about something, always has led to lower churn ratios. That's point number one. Point number two, you see, even when we own something, we are extremely gradual in building exposure. Let's assume that we have zeroed in on a highly liquid stock. Regardless of the liquidity of that stock, we would still take a few months or a few quarters to gradually build up the exposure into that business because that's just how we are comfortable in doing it. Also on the way down, if we realize that either the business is losing steam on growth or perhaps is getting weaker on the quality parameters in terms of cash flows or profitability, we would again try to reduce slowly on the way down. I think these two factors again provide us a lot of comfort in terms of growing size. Last but not the least, you see at any stage, we are always having 30 to 40% mid and small caps in our portfolio. Now, at a point in time, while the mid and small caps may have low liquidity, but our experience over the last 20 years has been that if your selection is right, and if it is proven to be right in the fullness of time, these businesses grow in size, and as they grow in size, they become more and more liquid. So we've seen a case of actually liquidity increasing intrinsically in our portfolio over time, because as businesses continue to grow, as businesses grow profitably, their liquidity in the marketplace also increases. So organically, the liquidity of our portfolio today, ceteris paribus, will only improve in the years to come. That also is an enabler of increasing size in our strategy. So the last point is basically how we have seen the evolution over the last 10 years. On that basis, at the present size, we really don't think this is a factor of worry for us. Yeah.
Understood. Thank you so much for that. Now, as a follow-up question to you, I know we have heard this a lot of time, and this is testament to the way the portfolio has performed. What do you think have been the main contributors to the strategy's outperformance this year?
Sure. Actually, it's been spread across different sectors and different businesses. I think what we've always told you, and which is something we always share with you in terms of inputs. When we look at our alpha generation, a big chunk of it comes from stock selection rather than sector selection. And the last 12 months have been no different. The last 12 months have also been, a function of our stock selection going right. Of course, IT services as a sector has done well. So therefore, most stocks, if not all of them within that sector, have contributed. But I did mention to you that the consumer sector has not done very well. But in the top are sitting a couple of consumer names, which despite the overall sector not doing well, have helped us. I spoke about private sector banks actually not performing well in the last 12 months. But within private sector banks, we have a couple of exposures which have actually done very well for us. So regardless of, regardless of the fact that which sectors have done well or not, because a larger chunk of our alpha generation comes from stock selection, we've seen it spread across different sectors and different industry classifications. Yeah.
Thank you, Ajay. I think it's really great to see the strategy working well amongst all of the sectors that the portfolio is concentrated in. Now, another exciting question, and this will be directed to both you gentlemen, Vetri and Ajay. What are the reasons for the many IPOs in the country this year, despite the pandemic? Part one of the question. And as a part two, do you see any opportunities for the portfolio in this space?
Yeah, sure, Vishal. Maybe I'll just take that first part. But even before I get to that, I just noticed there was a question in the chat, perhaps relating to data we had shared earlier about the vaccinations. So just to be clear, if you look at India's total population, 18% of the population has received 2 doses, so fully vaccinated. But remember that India's population, nearly 42% of the population is below the age of 18, who are currently not yet being vaccinated. So if you take the 18 plus population, that number would be closer to about 32 or 33% of population having received 2 doses. And the estimate is that by the time we get to December, 60% of that 18 plus population would have got 2 doses. So I just noticed that question, so I thought I'd clarify that data point. Now, coming back to your question on the IPOs, it's very simple. India has been favorite hunting ground, not only for bottom-up stock pickers like Ajay, but for the entire PE and venture capital, system. And therefore, as a result, some of the data we have suggests that close to $60 billion has been invested by PE and venture funds into startups between 2015 and 2020. And in fact, in the current year alone, another, about $20 billion of flows are likely going into predominantly these, tech startups. But I'd say there's a wide variety of startups related to tech as well, which are attracting capital. The reason why you're seeing such a hot IPO market, most of these companies, many of whom have actually been getting funded all the way going back perhaps to the start of the previous decade, have now reached a point, and perhaps the last 2 years of tailwinds because of the pandemic are actually giving them the size and scale where they've been able to now come to the market. So these IPO companies who are coming to the market, actually predominantly the amount of capital that's being raised is by way of an exit for the pre-existing Ps or VCs who are now diluting their stake and letting the company get listed. Of course, some of them are also raising growth capital simultaneously, but that's the reason why you are seeing this IPO market. A lot of these companies got funded earlier. Thanks to the pandemic, you've sort of seen their scale advantages play out. You've perhaps seen consumers learn a new way of doing things. What's also enabled the scale transformation, keep in mind, is the radically low cost of telecoms in India, which sort of debuted in 2017. And accompanied with that was the creation of the India Stack, which is essentially a know your customer and completely digital authentication system. So when you combine cheap telephony, you combine it with the India Stack, you combine it with the fact that consumers discovered this whole internet-based, buying system over the last 2 years, many of these businesses have got the scale which have allowed them to come to the market. So it's a combination of circumstances which are now driving these companies, having achieved a certain scale, to come to the market and get listed. I think for the second part, over to you, Ajay. Maybe you could talk about some of the stuff the team and you have been looking at in the IPO space.
Yeah. So I did allude to this when I was talking about our portfolio earlier on. And you see, yes, the fact is that India is a very vibrant market in terms of the secondary market, and that is also helping a lot of these IPOs coming in. But we would use the same principles that we've been using all along. We are not going to get carried away in terms of the fact that, look, there are a lot of IPOs coming. They're all usually listing at 30-40% gain. So therefore, we should also be participating in them. Instead of looking at how their price would perform over the next few quarters or months, we will always be looking at what is the business that they are bringing to us. Does that business solve a particular customer problem? And are they going to scale up this business profitably? If the answer to this is yes, we would certainly be ready to back up these businesses. But the gratifying thing, of course, is that, like Vetri mentioned, a few of these businesses have been able to put out their proof of concept, have been able to scale themselves up to a point at which investors like us, which look at the longer term, are getting reassured that, look, they are showing all of those signs that we look for before investing. And these could be spread across consumer tech names. These could be spread across, certain businesses coming on the healthcare side. So there could be a wide variety of businesses coming in. We are also seeing a lot of action happening in the insurance space here in India. So we would be open to all of them. But let me just make this point abundantly clear. We would always be enthused by the business rather than trying to catch on to the IPO bandwagon.
Thank you so much, Vetri and Ajay. I think it was a really great highlight of the IPO market within the Indian economy, how a bunch of investments have come into new age technology. There's not only helping the consumer move forward, but also the way the new products are launched. And it's also great to see that the portfolio still sticks to its really grounded rules in terms of monitoring these IPOs and the various sectors that they eventually play into. Now, as a follow-up question on this, both to you, gentlemen, we see a lot of private equity coming into the market in the next few years. Firstly, how is this impacting the index weight? How keenly do you follow, or how closely do you follow the private equity space? And the second part of this question, is it correct to say that America is heavily helping investing into the digitalization in India to be an important player in this segment? And by doing this, is this not creating any conflict between the relationship with China from India's perspective in regards with this partnership, so to speak, with the United States?
Yeah, Vishal. So, there was a lot packed into that question. I think India remains a fairly favored destination for PE and venture money because of the positive experiences that they've had of investing here. And the ramp for onboarding customers is looking even better because of, as I mentioned earlier, the cheap telephony and the India stack-based authentication system, and lots of other sort of movement happening in the technology world. So I think it will remain a favored destination. As I mentioned, even in the current year, the numbers are very strong in terms of the capital flows into the services area. I'm not sure this is any master plan either on the part of the Indian government or on the part of the US government to sort of target this opportunity. I think it's more organic, it's more bottom up, it's a function of the entrepreneurs and the opportunities. Very specifically, you did allude to China. Given the tensions between India and China, India has taken certain steps to both sort of limit the entry of Chinese capital into India, to limit some of the sensitive areas as defined by India, where China would not be able to invest. And in fact, I would say some of the companies which have recently come to the market to list, one of the reasons they've also come is that perhaps their primary capital providers many years ago was actually a Chinese VC or a Chinese origin fund. And one of the reasons they are coming to market is for this company to now sort of disentangle itself because of the entire, foreign policy and economic back and forth between India and China. So that is a sort of contributing factor, but on both sides, I don't think one would expect some of the Chinese investors who've been aggressive in the past in India to continue putting money. And if anything, they're actually now exiting. But maybe there's some capital which was looking to go into China, where people are now saying, because of what's happened in China, we want an alternate destination. And, India then relatively starts to look attractive to them. So again, it's a confluence of things rather than a single point.
Thank you very much. That was indeed very insightful. Just on an follow-up question again, in this space, both again to you, Vetri and Ajay, would you be able to provide us on the upcoming IPOs of promising Indian companies that you are closely monitoring or in fact excited about?
Ajay, you want to take that? And anyway, Vishal, what I would say, we'd be very happy to share with you a list of all the companies that we know have either filed their draft red herring prospectus or which we know are working with bankers. So I can share that with you later, and you could send that to whichever clients are sort of keen to see that. Ajay, you want to add anything?
Sure. Yeah. So very quickly, I think it is across the board, Vishal. I don't think we are seeing a preponderance of IPOs only from one particular sector. It will also be unfair to say that most of these IPOs are coming from the technology domain alone. Of course, when we said technology, what we meant was that companies from the technology domain truly were missing in the overall scheme of opportunities for an Indian investor till about a couple of years back. But now we are seeing a lot of these technology companies coming in. Like Vetri mentioned, after reaching to a particular threshold and scale, they are now coming on to public markets because they are ready to actually provide paths towards profitability. And in fact, those that have reached profitability are very confident on sustaining their profitability. So I think those are the new ones which excite us because they were missing from our portfolios because we never had an opportunity to invest. Other than that, there are a host of IPOs coming in from sectors across the board, and we would continue to evaluate them, keeping our core parameters in mind. So happy to send you the list, but I can just say that it is indeed across the board, but the new exciting opportunities for us are from the tech side.
Understood. Thank you, gentlemen, for that informative answer. We're definitely looking forward to be able to seeing the list of the upcoming IPOs, and I'm sure our partners and clients will find that very, very helpful. Vetri, just a bit something that's very recent in the financial narrative and media, as good as about 2 weeks. Now, there have been reports here, I guess in the Western press, that India could be heading for a supply side shortage of energy, namely coal supply. Now, do you think could this have an impact on the wider economy and any concerns for the names currently in the portfolio as a result of this energy supply crunch or shortage for that matter?
Sure. So just on the first part, you're right. So one of the data points that is tracked locally is the number of days of coal stock available with the thermal power plants for whom, coal is a fuel. And it has dropped below the critical threshold at a large number of plants. Now, what's the reason for this? It's sort of twofold. One is, or rather threefold. One is that, I think the recovery in demand in August in particular for electricity was very, very strong. And I think that sort of caught the system a little bit unawares. Also because, remember, the coal stock which typically India needs in June, July, August actually has to be mined in the previous 3 months, because remember, June, July, August is when the monsoon in India is most active. So I think these two sort of factors combined in an unfavorable way, in the sense that demand came in stronger, and unfortunately your supply of what's available in August is actually a function of what you mined in April, May, and maybe even the first half of June. But because this demand was so strong, the power plants started to run slightly short. The second thing which also happened simultaneously is that I think there's been some disruption of gas supply, though gas power plants make up a very, very tiny fraction of total base load supply in India. So I think it's essentially the coal-related situation. My sense is this is more short-term. I don't see this as having longer-term ramifications. There could be some damage to a particular company's earnings in this quarter or the next quarter, simply because coal is now getting prioritized for the power generating companies. And therefore, some of the companies operating either in cement or in steel or in aluminium could find their coal supply is slightly short because it's being prioritized for the utility sector, and there could be some production related disturbances. But it doesn't look like a countrywide sort of significant setback to production ramp up. So, that's the way I would sort of capture that. Is there any impact on portfolio companies? I would say not much, because we don't really own anything which is directly in that sense involved in, mining or in power generation. But Ajay, you want to add anything there?
No, actually, you're right, Vetri. We don't own anything in any of these areas, so therefore there is no direct impact. Is there going to be a second order impact? Possibly yes, but please do remember that we always, when we say quality, we always are trying to imply companies with a huge amount of pricing power. So is this going to seep into higher cost of operations for businesses of certain companies? Possibly yes, but through the cycle, the kind of companies we own should be able to pass it on to the customers and keep their margins steady, but no direct impact.
Thank you so much, gentlemen. We have had some sort of comments and questions come in throughout the time we have been hosting the webinar this afternoon, or evening rather. And one of our audience have actually sent a really great message to Mr. Ajay. Just would like to highlight this, and we do have some sort of questions coming in through the platform. First and foremost, there is from the audience the question to Mr. Ajay. Now, congratulations to the team UTI for its funds. Dynamic equity has outperformed its peers by a wide margin and has done well. But if you could go back in time, what do you think you could improve on your portfolio, and if you had any misses over the last few years? And also, do you think that wealth creation in India will take place more in the private equity space rather than the public markets, in the coming decade, for that matter?
I'll take the first part, and maybe Vetri can help me in the second part of the question. You see, as far as what have we missed out, or some mistakes, as you say, you see, every year we would end up doing mistakes. And like Mr. Warren Buffett often says, these mistakes fall into two brackets: errors of omission and errors of commission. Our errors of commission are always evident to you. We have, thinking that businesses are high quality, we have made investments into businesses which eventually did not prove to be high quality, which eventually did not create value, in fact, destroyed value. But these are the ones which are evident to you because we do discuss about them, and these are visible to you. But there are a whole lot of businesses which have been left out, which we haven't been able to pick up at the right time. We haven't been able to gather enough conviction on them. And these are the ones which are errors of commission. And to my mind, they always are the biggest source of, I would say, mistakes for asset management. The way this industry works is that if you are a portfolio manager who's actually taking care of risk management and who's running the portfolio in a very diversified manner, your errors of commission would not lead to a big drag on your performance, because you would have limited the underperformance even if the business were to fall down 50%. But if you actually did not buy a business which eventually proved to be a really great business to own, then your mistake would be very costly, because you actually missed out on the entire wealth creation going all the way, from 1 to 100, or sometimes even 1 to 200 in terms of the overall wealth created by such businesses. So there have been errors of omission by us as a team. As a team, what we are very conscious about is that we should make all out efforts in understanding every business. We may not like 95% of the businesses, but that doesn't mean that we don't knock at every door and we don't actually lift every stone to see what's lying under. So I think that's the big lesson for us, and we are mindful about it. And this is how we would try to reduce our big mistakes towards wealth creation in future. Vetri, you want to take the one on private equity versus public markets?
Yeah, sure. So, I actually think there is a opportunity for both to participate and to do well. Ajay referred to Jubilant Foodworks in his comments. Jubilant Foodworks has been listed now for more than a decade. It's been a stellar performer. You've seen that it's a significant contributor to our performance. Jubilant Foodworks was actually backed by a PE company, and that PE company exited in 2010. So they didn't make too much money out of it, actually. I think there's been more money made in that company in the public markets. But, it's just one example. But I think, to me, it's a tale of how there is room for both PE and there is room for public market investment. And perhaps companies at an earlier stage are certainly better off going to PE or VC, because they don't yet have the sort of story or the sort of credibility in terms of everything that goes into being a listed company. And the burden of being a listed company in terms of compliance is quite extensive, right? In your early days, you'd rather be able to focus on your business and not worry about the regulatory layers that come in the minute you become a listed company. So I think this is a balance that entrepreneurs will have to strike. There is a role for both private and public markets in India. I think both can thrive. I don't see it as a either or situation. And if I look at the US market, it hasn't been an either or situation there as well.
Thank you so much, gentlemen. Just on a very topic that probably we haven't touched on in just snips of the fairly discussion, how is the incorporation of ESG in an investment process coming along within the companies that the fund looks at on a whole, and also especially within the India Dynamic Fund?
Petri, you want to take that? Or
Yeah, sure. So I think in terms of the incorporation of ESG, we've made significant progress over the year. Of course, a year ago is when we signed up to the UN Principles for Responsible Investing. We put in place a policy. Happy to announce that in the previous quarter, we actually hired a full-time ESG analyst into the team. This was always part of our plan to bring in somebody full-time to lead the ESG effort within the research team. So he's on board. Suraj Purohit joined us in July, and he's working closely with Sachin, who's our head of research. All the analysts have already put together their templates in terms of the various metrics that we are now starting to track for. I think we've started with the top 150 companies in our universe. Remember, as a team, we cover almost 350 companies, but we've identified 150 companies as the first set of companies that we want the team to pay attention to. So those are the 150 where they've developed sector-wise frameworks, right? Because when you're looking at the power sector, there's a different set of metrics that you want to focus on. When you're looking at an IT company or a bank, there are a different set of frameworks and data points you want to look at. So, these frameworks are now being created on a sectoral basis. The analysts have started to implement them. These are part of the research reports that they write and the discussions that we have, either internally as a team or with the company. And increasingly, I see Suraj as the ESG analyst sort of, driving the evolution of that framework. As far as the G angle is concerned, as we've said before, UTI has a long reputation of engaging regularly with companies, and voting is, a big part of things that we do. So we've continued to, vote. We've not missed a single resolution through the voting season. We will continue to vote, and we use 2 external frameworks or advisors, IIAS and SES, both of which are homegrown proxy advisory services. So we actually get 2 inputs before, the team sort of takes a decision. Of course, the decision is finally ours, but we get the benefit of these 2 frameworks. We've also, started to use Sustain Analytics, both because it gives us some sort of a framework, as well as it gives us some very specific data points that we are looking at. To my mind, the challenge now is more to standardize the frameworks, pin it into the investment argument of our companies. And just as a sidelight, one of the biggest challenges for us in pushing this in India is the level of disclosures. But the securities regulator earlier this year came out with short form BRSR, which will be applicable from the financial year 23. So that's the year ended March 23. And I think that becomes applicable on pretty much the top 200 odd companies in the country. So that will, for the first time, give us a standardized set of data that all companies will have to report to us. But we are actually expecting that, I think I won't be surprised if the top 100 companies actually adopt the BRSR standard and start giving us the data from the March 22 reporting season. So I'm quite optimistic actually that our frameworks will be, fully solidified and standardized by the time we get through the reporting season of 22. Right now, while we've developed the frameworks, there are gaps because some companies just don't disclose it, particular kind of information, because they're not required to. So we've got the frameworks in place. I think March 22, we'll be able to start sharing some of this. The level of standardization will improve because the regulator is asking the companies to give us this information. And I think, we'll just continue to build on this and make sure that, to my mind, the most critical part of this is incorporating particularly the costs related to E&S into the financial modeling that the analysts are actually doing and into their investment arguments. And I think over there, we've made a pretty solid beginning with, the analysts really sort of starting to incorporate the negative externalities that companies are having on the environment and the economy into their financial models. So it signals to the fund manager as well a very explicit recognition of the risk and what it means to creation of value by the business or the enterprise. So, quite happy with where we are. We're hoping to put out a more sort of detailed update at the end of December. So maybe it will hit your inboxes sometime in January in terms of the level of frameworks and some sort of a rudimentary data set reporting for the portfolio companies in the IDEF fund. Ajay, you want to add anything to that?
No, Vetri, I think you've summed it up perfectly.
Yeah.
Thank you very much. It was very well narrated. It was great
Sorry,
to
Vishal,
see. Yes.
Just to add, I forgot to mention one more point, which is, of course, as an asset management company, I spoke more in the context of the investment team, but as an asset management company, there's actually a board-led, the board ESG committee, which is involved in driving the ESG credentials of the company UTI Asset Management Company Limited. That's led by Mr. Fleming, who's a representative of T. Rowe Price on the board. And the company has actually now appointed Deloitte to work with us in terms of creating the framework for UTI Asset Management Company for our reporting framework as an organization. So the investment framework is something that my team takes care of. But the company level reporting framework, because remember, UTI-AMC is also a listed company now. That's an effort which is being run by the board, Deloitte supporting, and the CFO's office supporting, in fact, along with the ESG members of my team.
Understood, gentlemen. Thank you so much. It was very great to see how the firm is adopting the ESG framework and how the investment thesis is built and continues to grow within the firm, both at the stock analyst level and at the corporate level. Guys, just in the essence of time, we have still quite a number of questions coming in, but I just want to close off the session with a final question on a two-part series to both you gentlemen. And it's great to see our audience are very actively engaged with us in our conversations today. The final question for our session is, once the economy starts to function again fully, when you see the reopening fully within the domestic economy, do you see less capital flowing into the stock market? And the second part is, what is your view on the Indian rupee and how foreign flow to India, and what about the foreign flow to the Indian stock market so far? And how will this change once the economy is indeed fully reopened?
That's an interesting question. I don't look at it that way, but just looking at my experience in markets over now almost 30 years, there's no way that the money flow stops because activity in the real economy starts to pick up. The only reason money inflow into the market really comes to a halt is because the positive sentiment that is being driven by rising prices comes to a halt, and for whatever set of reasons the music stops playing. So to my mind, that's the bigger sort of risk to capital flows. And the reason I say that is that there's been an absolutely mind-boggling increase in the number of opening of retail brokerage accounts as well as mutual fund accounts with us, right? So those numbers are completely off the charts. In the last 3 months, I think India added about 10 million demat accounts, which is what you need to open if you wanted to start trading stocks. The previous 10 million accounts took about 13 months. The previous 10 million accounts took about 3.5 years. And the previous 10 million accounts took about 5 years, right? So it's like an exponential curve in terms of the way the numbers have been adding up and how money has been flowing in, both directly into equity markets as well into mutual funds. In fact, if you look at the data, which is released by the exchanges, the biggest driver in the market year to date is not foreign investors. It's actually hardcore domestic money and significantly retail money. I think it's a little bit of a gravy train right now in terms of people sort of receiving positive reinforcement from those gains. There will be a shakeout at some point of time, I'm sure. But overall, I think it's a healthy trend because anything that causes Indians to move away from the safety and security of bank deposits and starting to think about how they need to have equity exposure to plan for the longer term, I think that is only welcome. So I see it as overall a positive trend. But yeah, anything that is this sort of retail momentum driven, you need to be careful in terms of abrupt mood changes that can happen.
Thank you very much. Yes, I would like to bring our session to a close. And again, Mr. Vetri, Mr. Ajay, Mr. Praveen, thank you so much for sharing your insights throughout on the portfolio level and on the global economy. I think we learned something very valuable today. And I would also like to thank all our participants and clients from all over the regions and the world joining us in our quarterly Outlook webinar for Indian equities. And on behalf of UTI Asset Management and UTI International, I'd like to thank everyone that has made this webinar a success. And again, a big thank you to our distinguished speakers, Mr. Praveen, Mr. Ajay, and Mr. Vetri. Thank you so much. I wish you all a great evening and stay safe, stay healthy. Until we meet again. Thank you.
Thank you, everyone. Good day.
Thank you. Thank you, everybody.
Thank you.
Thank you.